Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. Three major mistakes to avoid when trading cryptocurrency future market. Crypto traders love to ape and make gain investment using high leverage in future market, but most traders fall victim to these three key mistakes. Many traders frequently express some relatively large misconception about trading cryptocurrency futures, especially on derivative exchange outside the realm of traditional finance. The most common mistakes involve future market price decoupling, fees, and the impact of liquidation on the derivative instrument. Let's explore three simple mistakes and misconceptions that traders should avoid when trading crypto futures. Derivative contracts differ from spot trading in pricing, and currently the aggregate future open interest in the crypto market surpassed $25 billion, and retail traders and experienced fund managers use this instrument to leverage their crypto position. Future contracts and other derivatives are often used to reduce risk or increase exposure and are not really meant to be used for direct gambling. Despite this common interpretation, some differences in pricing and trading are usually missed in crypto derivative contracts. For this reason, traders should at least consider this difference when venturing into future market. Even well-versed derivative investors from traditional assets are prone to making mistakes, so it's important to understand the existing population before using leverage. Most crypto trading services do not use US dollars even if they display US equities. This is a big untold secret and one of the pitfalls that derivative traders face that cause additional risk and distortion when trading and analyzing future market. The pricing issue is the lack of transparency, so clients don't really know if their contract are paid in stablecoin. However, this should not be a major concern, considering there is always the intermediary risk when using centralized exchange. Discount futures sometimes come with surprise. On September, Ether or ETH futures that mature on December are trading for $22 or 1% below the current price at spot exchanges like Coinbase and Kraken. The difference emerged from the expansion of merge for coins that could arise during the Ethereum merge. Drops can also cause discount future price since the holders of a derivative contract will not receive the award, but that is not the only has its own pricing mechanism and risk. For example, Polkadot quarterly future on Binance and OKX have been trading at a discount versus DOT price on spot exchange. Notice how the future contract traded at a 1% to 4% discount between May and August. This backwardation demonstrates a lack of demand from leverage buyers. However, considering the long-lasting trend and the fact that Polkadot Rail, the future contract price has decoupled from spot exchange, so traders must adjust their target and entry level whenever using quarterly market. Higher fees and price decoupling should be considered. The core benefit of future contract is leverage, or the ability to trade amounts that are larger than the initial deposit. Let's consider a scenario where an investor deposits $100 and buy long $200 USD worth of Bitcoin or BTC future using leverage. Okay, maybe that's all from me. Don't forget to like, comment, share, and subscribe.